This is the story of how 9,000 banks failed in 4 years, trapping $7 billion in savings, and why some analysts believe we're heading for a similar crisis in 2026. Between 1929 and 1933, 40% of America's banking system vanished without a trace, leaving depositors with no federal insurance and no safety net, just locked doors and empty vaults. Today, we've built protections those depositors never had, but we've also created vulnerabilities they couldn't have imagined, including banks that can lose $42 billion before the sun sets. The Great Depression banking crisis arrived in 4 waves, each one more devastating than the last, and nobody saw the full scope until it was too late. November 1930 brought the first wave when Caldwell and Company collapsed with over $200 million in assets, a financial titan they called the Morgan of the South. When it went down on November 7th, the dominoes started falling immediately, taking the Bank of Tennessee and affiliates in Knoxville and Louisville with it. December alone saw 352 banks suspend operations, and this was just the beginning. Chicago became the epicenter of the second wave between April and August 1931, where 563 banks drowned in bad real estate loans that suddenly weren't worth the paper they were printed on. The third wave went nationwide after Britain abandoned the gold standard on the 21st of September 1931, triggering a panic that suspended 817 banks in just 60 days. But here's where it gets worse. Michigan declared an 8-day bank holiday on the 14th of February 1933, and within weeks, the contagion spread to every corner of the country. All 48 states either closed their banks completely or restricted withdrawals to a trickle. And by March 3rd, you couldn't find an open bank anywhere in America. 24,000 banks operated in January 1929. 4 years later, only 14,000 reopened their doors, which meant 9,000 institutions simply ceased to exist. $7 billion in deposits sat frozen in failed banks, and this is what made it truly catastrophic. No FDIC existed. When your bank failed, you became what they called a general creditor, and courts appointed receivers to sell off whatever assets remained. Months would pass, sometimes years, and you might recover cents on the dollar if you were lucky, or you might get nothing at all. One failure changed everything. The Bank of United States collapsed on the 11th of December 1930 with $200 to $286 million in deposits belonging to 400,000 people, mostly Jewish immigrant merchants scraping out a living on New York's Lower East Side. 20,000 people gathered at the Southern Boulevard branch in the Bronx on December 10th after a rumor spread through the neighborhood, and in a single frantic day, 2,500 to 3,000 depositors pulled $2 million out the door. The name fooled people into thinking the government backed it, but the bank had zero connection to the United States government, and when managers Bernard Marcus and Saul Singer were later imprisoned for fraud, that didn't help anyone get their money back. That one institution accounted for 1/3 of all deposits lost across 608 failed banks in the final 2 months of 1930. 9 million Americans watched their savings disappear. Unemployment climbed to 25%, and President Hoover seemed powerless to stop it. The 6th of March 1933, at 1 in the morning, changed the game. Roosevelt issued Proclamation 2039 declaring a national bank holiday that closed every single bank in America for 4 days, and on March 9th, Congress passed the Emergency Banking Act the same day it was introduced, with the House vote taking 40 minutes and 0 amendments because nobody had time to debate. 3 days later, 60 million people pressed their ears to radios for Roosevelt's first fireside chat, where he explained exactly what happened to your money the moment you handed it to a teller. The bank does not put the money into a safe deposit vault. It invests your money in many different forms of credit. A comparatively small part of the money you put into the bank is kept in currency. Then came the line that restored confidence. I can assure you, my friends, that it is safer to keep your money in a reopened bank than it is to keep it under the mattress. When banks reopened on March 13th, something unexpected happened. Deposits exceeded withdrawals, and $1 billion flowed back into a system everyone had declared dead 3 weeks earlier. The 16th of June 1933 brought the Banking Act that created the FDIC, and coverage started at $2,500 per depositor on the 1st of January 1934. 9 banks failed in 1934 compared to 9,000 in the previous 4 years, and according to the FDIC, no depositor has lost a penny of insured funds since that day. 90 years later, history repeated itself at digital speed. The 9th of March 2023 saw Silicon Valley Bank depositors withdraw $42 billion in one day, setting a record for the largest bank run in history, and another $100 billion sat queued for the following morning when regulators seized the bank. $209 billion in assets made SVB the second largest failure in US history at the time, and the collapse took exactly 44 hours from the moment they announced a capital raise to the moment regulators locked the doors. The cause was simple: math turned catastrophic. SVB held 55% of its assets in fixed income securities, like bonds and mortgage-backed securities, more than double the industry average of 24%. And when the Federal Reserve jacked interest rates from near 0 to 5.25%, those securities lost massive value overnight. 88% of their deposits weren't covered by FDIC insurance. Signature Bank followed 3 days later with $110 billion in assets, 89% uninsured deposits ranked as the 4th highest ratio in America, and heavy crypto exposure that put 30% of their deposits in digital assets. First Republic Bank became the second largest U.S. bank failure ever on May 1st at $229 billion in assets, surpassing even SVB, after depositors yanked $25 billion in one day and another $40 billion in the days that followed. 11 large banks scrambled to inject $30 billion in emergency deposits on March 16th to stop the bleeding, but nothing could save First Republic by that point. 3 of history's 4 largest bank failures compressed into 2 months, and the FDIC burned through $22 billion, making depositors whole. Mobile banking rewrote the rules between 1930 and 2023, and that's what makes today fundamentally different. The 1930 bank run at the Bank of United States took a full day for $2 million to walk out the door in cash, and people considered that catastrophic. Silicon Valley Bank lost $42 billion in the same time frame through digital transfers that happen in seconds, coordinated by social media posts spreading panic in real time, 44 hours from healthy to seized. That's a structural vulnerability that simply didn't exist in any crisis before the internet age. So here's where the banking system actually stands right now, stripped of spin and political talking points. Interest rate spikes hammered banks holding long-duration bonds, and as of the 4th quarter of 2024 US, banks are carrying $482 billion in unrealized losses. That number represents 8.6% of the fair value of all securities holdings and nearly 20% of aggregate equity, and the system has endured 10 consecutive quarters of these unusually high unrealized losses since early 2022. Commercial real estate presents an even bigger threat. Banks hold roughly $3 trillion in CRE loans, representing 51% of all commercial real estate debt in America, and regional banks account for 80% of that lending. Office vacancy rates hit 21% in the 3rd quarter of 2024, up from 12% before the pandemic, and office loan delinquency just reached 11% in December, a record high that exceeds the worst months of the 2008 crisis. $1 trillion in commercial real estate loans will mature between 2024 and 2026, mostly 5 or 10-year balloon loans originated when rates were low, and now borrowers need refinancing at double or triple the original rate. 67 banks with over $10 billion in assets have commercial real estate exposure exceeding 300% of their equity, which means a significant default wave could wipe out their capital cushions. New York Community Bancorp showed what happens when the market loses confidence. January 2024 brought a $252 million loss, and their stock cratered 37.7% in a single trading day. Moody's downgraded them to junk status by February, and they needed a $1 billion capital infusion in March just to stay alive. Their commercial real estate exposure measured 617% of their capital ratio, the highest among large banks. Uninsured deposits create another pressure point. Bank of New York Mellon runs 100% uninsured. State Street sits at 92.6%. Northern Trust holds 73.9%. And even JP Morgan Chase carries 51.7% of its deposits above the FDIC insurance limit. 66 banks with $83 billion in assets appeared on the FDIC's problem bank list as of late 2024, which falls within the normal range of 1 to 2% of all banks, but sits at the elevated end. But here's what separates us from the 1,932 depositors who lost everything. The FDIC Insurance Fund holds $137 billion, backing every deposit up to $250,000 per depositor, and they can pay out within 2 business days of a bank failure. Bank capital requirements didn't exist in 1929. Basel III now requires banks to maintain a common equity Tier 1 ratio of at least 7%, and most large banks actually run at 13 to 14%, well above regulatory minimums. Stress testing hits every bank over $100 billion in assets annually. The Federal Reserve acts as lender of last resort and lent $165 billion through the Bank Term Funding Program at its peak, and Dodd-Frank created resolution authority allowing orderly liquidation of failing institutions instead of chaotic closures. But we've also built risks that nobody in 1929 could have imagined. The global derivatives market carries $699 to $710 trillion in notional value, roughly 10 times the entire global GDP. Shadow banking, which means financial institutions operating outside traditional bank regulations, holds $239 trillion in assets globally, representing 49% of the entire financial sector with no FDIC insurance, less regulatory oversight, and no Federal Reserve access when things go wrong. And there's still that speed problem. Digital bank runs drain institutions in hours instead of days, turning a liquidity crisis into an existential threat before regulators can respond. So, what are the experts actually saying about 2026? JP Morgan pegs recession probability at 40% by the end of 2025. Goldman Sachs raised their forecast to 45% after recent tariff announcements, and Jamie Dimon warned in April 2025 that tariffs will likely increase inflation and raise recession probability, with interest rates potentially spiking to 8% or higher. The Federal Reserve's November 2024 Financial Stability Report lists persistent inflation and tight monetary policy as the top risk facing the system. The IMF calculated a 1 in 20 probability that global output contracts by 1.3% over the next year. But here's the reality check that bears repeating. Many bearish predictions since 2021 haven't materialized. Nouriel Roubini, the economist nicknamed Dr. Doom for his pessimism, said in December 2024 that the near-term outlook for the US economy heading into 2025 is relatively benign. Michael Burry, famous for predicting the 2008 crisis, made at least 5 dire predictions since 2021 that didn't pan out according to the Wall Street Journal. Being early on macro calls often looks identical to being wrong. So what does all this mean for the money sitting in your account right now? Deposits under $250,000 in FDIC-insured accounts carry protection that fundamentally didn't exist in 1930, backed by $137 billion in the insurance fund, plus the full faith and credit of the United States government. But cross that limit, and you're standing in the same position as those 400,000 depositors at the Bank of United States in 1930, completely uninsured. 88% of Silicon Valley Bank deposits exceeded the insurance limit, and 47.5% of deposits in Cyprus got seized outright in the 2013 bail-in when their banking system collapsed. The Congressional Budget Office projects national debt will reach 156% of GDP by 2055. The government burned through $882 billion on interest payments in fiscal year 2024, more than defense spending or Medicare, and the Penn-Wharton budget model flatly states that financial markets cannot sustain more than the next 20 years of deficits under current policy. 400,000 people lost access to their life savings on the 11th of December 1930 when the Bank of United States failed, with no insurance, no protection, just locked doors and empty promises. Today we've built safeguards those depositors couldn't have imagined, but we've also engineered vulnerabilities they never faced. $482 billion in unrealized losses sitting on bank balance sheets, $1 trillion in commercial real estate loans coming due in the next 2 years, and banks that can collapse in 44 hours instead of 4 months. The question isn't whether we'll see another 1,929. We won't, because the system operates under fundamentally different rules now. What matters is whether our modern protections can handle modern risks moving at modern speed, because the next time 20,000 people show up to pull their money out, they won't be standing in line at a bank in the Bronx carrying withdrawal slips. They'll be tapping their phones from their living rooms, and $42 billion will vanish before anyone realizes what's happening. That's what makes your savings both safer and more vulnerable than at any point in history.